Περνάμε τώρα στον κύριο William NOURSE, Managing Director, Financial Institution Group της Deutsche Bank.
Good afternoon, ladies and gentlemen. Thank you very much for having me here. I apologize, much like Luigi Rizzo, I unfortunately don't speak Greek, so you're going to have to listen to my English. Just to briefly introduce myself, as I was introduced, I was a Managing Director in our corporate and investment banking business. You've already heard my partner, Dimitris Stathopoulos, talking from the Greek side. I look after financials. I look after financials ranging from South Africa to Greece to Turkey and back into the UK. Now, because I'm an investment banker, I'm not going to talk, I'm not an economist or indeed a commercial banker. I'm going to give you largely a market-led view and answer the question, and I look forward to the debate. So if I structure my thoughts, I think it's quite important to say what are you talking about. So I thought, what is the heel? We need to frame the whole debate. Then we need to work out whether Paris's area actually does lurk within southeastern Europe. If it does, I want to say what it could be. And then based on this, I want to work out what the impact could be on the Greek banks. I think also, to provide a balanced debate, I think we need to ask two more questions. Number one is, why did Achilles have his heel in the first place? And number two is, just perhaps because I've been asked a leading question, are we actually looking in the wrong place? And after that, I'll give you some of my concluding remarks. So what are we talking about? Are we talking about, I think, in this whole financial crisis, there's been a lot of hyperbole. And I think there's a lot of misdirected comments and ill-informed debate. The point of this slide is I'm pretty convinced quite soon you're going to have a film which is called Lehman and the Financial Meltdown, where Brad Pitt will undoubtedly be playing Hank Paulson. And let's hope it's not quite as inaccurate as his portrayal of one of your true great heroes. So when I think about the question, I think, is the potentially fatal weakness of the Greek banking system southeastern Europe? But as I'll talk about later on, we need to ask a much more balanced debate about why he had his heel in the first place. I do think it's quite important that when you're talking in the current climate around systemic risk, you can't just be glib about fatal weaknesses. So when I'm talking about a fatal weakness, I'm talking purely allegorically. Let's go on. So is southeastern Europe on the brink of collapse? These press clips would suggest they would have done. I think it's interesting to note the first one is in October 2008, but the very last one here is in June 2009. So some people are pretty convinced that southeastern Europe, it's all gone. I think it's particularly interesting that Paul Krugman, quoted at the bottom, is a Nobel laureate, and he says the US economist Paul Krugman said that Austria risked bankruptcy owing to its large exposure in Eastern Europe, although Krugman admitted he did not have exact figures. I think that's quite irresponsible myself. The second point, again, is on the banks. The comments, again, are that effectively the banks are going to get brought down because of what's going on in Central Europe. I think it'd be fair to say that the stock market thought it was. I think that as Barack Obama said, what happens on Main Street is going to affect, or happens on Wall Street will affect Main Street. And what I think people were reasonably believing the decoupling story, as the summer wore on, people were realizing the downdraft in the large Western economies was going to influence what was happening in the more emerging economies. Clearly, the Lehman collapse in September, and along with this sort of, I would argue, technical selling pressure from the liquidity squeeze on the hedge funds created the sharp fall you're seeing. But again, I think we have seen some outperformance recently. So the stock market thought so. But I think the good news is that, that although this is a relatively busy side, the simple message is the international community realized there was a problem lurking in Central Europe. Again, I think if that's anything ranging from Barack Obama's first visit to Turkey, or the G20 which immediately preceded it, or else the IMF bailouts which followed straight afterwards. I think the importance of the international bailouts cannot be underestimated in this region. I think the second important thing that's happened is the differentiation has become clearer. I think the debate has now moved on from not the total destruction of Central Europe, but much more, will the contagion effect in the Baltics affect the Bulgarian peg and the implications for that? So I think there's been a big bailout, and I think that there's been a differentiation which is important. Well, this is a very simple slide that Dimitri showed already earlier on today, and I don't particularly want to dwell on the well-rehearsed debates around, the FX exposures in Bulgaria or in Poland, Romania, and the liquidity mismatching. But I do think it's quite important to learn the lessons from what's gone on in other countries and what this might mean for here. Luigi spent quite a lot of time talking about the United States, but as a Brit, I thought I might just spend a couple of minutes talking about what I think happened in the UK and what we could learn here. We saw the funding impact in the UK and Northern Rock and the ultimate nationalisation of that. And that then led to a series of guarantees globally on the deposit and on the funding side, which most countries have followed suit. I think debate moved on And the reason postulated for the lack of sort of credit flows in the economy was the capitalization of the banks, exacerbated by Lehman. That led to that famous weekend in October, where as a Brit, we spent a lot of time in the Treasury trying to assess how much capital needed to be injected and whether it had to be injected from the government or not. I think the conclusion was the amount had to be injected, and to some extent, some of it had to come from the government. I think, unfortunately, and this is the essence of my thesis on Southeastern Europe, is the debate's moved on much further than this, and it's now focusing on the asset side of the balance sheet. And again, we've seen massive asset schemes put into place in the United States and in the United Kingdom with the Royal Bank and HBOS. But I think it's this area which hasn't been followed by the rest of the world. There hasn't been an asset scheme for Central Europe, which I think could be a potentially interesting one to think about. I think it's relevant because the asset side is the one thing you can't guarantee. You can guarantee funding and you can put capital into banks, but you can't guarantee whether someone will pay their credit card or not next month. This chart here, therefore, highlights what I think, if you were looking at a fatal flaw in Southeastern Europe, what it could be. The chart's pretty simple. It talks about GDP growth or slowdown on the bottom axis. On the y-axis, it talks about NPL ratios. The problem is that to quote Krugman, this is quite a scary chart, and I think it's a misleading one and one that's often quoted. Bulgaria, loan losses peaking at 75% in 1996. The problem is we just don't know how deep the loan losses are going to be. I don't think they're going to be anything like this big, but to me, this is where if it came from Southeastern Europe, it's that. And similarly, the length and depth of that recession. So where do I think we are now? This doesn't purport to give an answer, but I think it's sort of interesting nonetheless. Dimitrios has already spoken about the GDP forecasts. There's a real slowdown in 2009, some recovery in 2010, and then back to the races in 2011. I think if you look at the top right-hand corner, which is Poland, which is probably the most sort of developed of the, I appreciate, not Southeastern European countries, there has been that strong decline, but I think they are going to start ticking up. On the bottom right-hand side, I've chosen three much more Central Eastern European focused banks. The point is the NPL is continuing to rise through 2010 and 2011. So having done all that, I want to say, why does this matter for the Greek banks? This chart is one which is well known. This is the GDP, the credit exposure to Eastern Europe as a percentage of GDP, and Greece is affected. This is a more granular chart, and really this tells you that the Greek banks are exposed to Romania, Bulgaria, and Serbia, with notable exceptions in the case of MBG in Turkey, Piraeus in Egypt, and EFG Eurobank in Poland. But again, I think the point again here is that it matters. So if I just come back to my three pillars. Liquidity. The Greek banks, on the whole, have a strong liquidity. And I think if this chart is broken out on a sort of more Greek, non-Greek basis, it's a broadly similar picture. There's one small thing on this chart which I think is quite interesting. If you look at the extreme right, that's the level of bank ownership of banking assets in each of the countries, from Poland at the top to Greece at the bottom. That is basically banks that are owned by foreigners or not owned by foreigners. My point here is that I think there could be a parallel debate to this one, which is if you're sitting in Romania at the moment, where 88% of the banking assets are controlled by non-Romanian owned banks, be it Erste Bank, be it the banks from Greece, they could be wondering whether in fact their Achilles heel is the foreign ownership of their banks. The inability for the governments, the subject of the debate of this meeting, the ability for governments to influence directly the lending patterns of those banks, I think is hugely significant to those economies more than to the Greek economy, where according to our statistics, only 37% of the assets are owned by foreigners. So liquidity, I think, we're there. Asset quality. Again, I think I talked a bit about this. To me, this is one area which is one to focus on. This chart is, again, very busy. The point I'd like to make, again, is top right-hand corner, which we call the high growth and high FX market share. What we've tried to do is we've plotted the average credit growth and percentage over the last 5 years. The idea being that the faster the assets got put on the books, the riskier quality they are. And on the y-axis, again, we've got the foreign exchange exposures. Again, this is lending in euros to individuals effectively paying for those in their own local currency. So therefore, we've mapped out Latvia is on the top right-hand corner of that chart. So there are some exposures to these fast-growing countries. My point on the right-hand side, though, is the Greek banks on a relative basis, in terms of their absolute NPLs, are relatively in good shape, again, compared to some of their peers. OTP up there peaking at 13.1%, according to our equity research. Bank of Cyprus at 6.1%. So why does that particularly matter? Well, again, as my previous talker said, capital is what it's all about. Capital's there to take those losses. And if you don't have the capital to take the losses, so I think it's just quite an interesting sort of parallel if you think about it. If the NPL ratios are forecast to go up, what's your capital to absorb those losses? And to the extent the Greek banks, which are the orange bars, are well to the left of that chart, on the extreme right, that's Unicredito, and then Raiffeisen International is the third one. The Greek bank's capital, seems to me, is an important one. So I suppose the analogy, come back to the Achilles analogy, if you're going to start playing in the Southeastern European fields, you need to make sure you have the armor to protect you when you do so. And to me, it's the capital ratios which are vital. I'm going to slightly digress again now and say, well, why did Achilles have his heel in the first place? Now, this data is all from January of this year. I suspect it's probably wrong. What it's basically showing is the penetration of loans to GDP on the left-hand side x-axis, and then GDP per capita on the left-hand side. It's the chart we've all seen, and the chart as an investment banker I've pitched numerous occasions to Alex and the other guys from the Greek banks, which is it's very underpenetrated. There will be growth in the banking sector in these markets as they move from left to right. The SEE is the bottom left-hand corner in both of these charts. The right-hand side is the deposits to GDP. So both on the asset and liability side, those markets are very underpenetrated. So again, as I said at the very beginning of my talk, do I think that Southeastern Europe is the Achilles heel of the Greek banking system? I think the answer is probably no. I think the big question there is the asset quality and the length and depth of the recession going on in those countries. I don't think anybody knows is the answer. I know this is not the question, but I slightly wondered if it was worth just thinking about that non-SEE exposure of the Greek banks. So if it isn't SEE, what is it? Well, broadly speaking, the non-SEE exposure of the Greek banks is to the Greek economy itself. I just wonder, to continue the analogy, is that the Trojan horse that people should be worrying about? Again, nothing in these statistics, we can draw out any of them, but basically speaking, it looks at the pressure on margins on the top left, then looks at the dislocation of the funding market, and to your point earlier, the funding is still expensive. But I think a top right-hand corner is an interesting one again, and one which should be troubling everyone, is the slowdown in credit extension, that feedback loop as you pull back credit from an economy, how does that feed through? And the final bottom right-hand corner is the GDP of Greece compared to some of its European peers. This wasn't the question, but I thought it was just an interesting one to throw up as a debate, which is in fact is the problem closer to home. So I'll just conclude. There's absolutely no doubt that SEE is under pressure. I mean, that's just given. The world has reacted, and it's reacted positively to the cry for help. The impact on the Greek banks is, I think, the liquidity, maintaining your liquidity and maintaining your positions in those SE markets is vital. The Greek banks benefit from the explicit and the implicit support in that system. To me, the key thing is the length and depth of the recession in Greece, as much as in Southeastern Europe, which is important. If you avoid the arrow now, the Trojan War still lasted 10 years. Do you have the ability to do that? But then going forward, I mean, positive, I think you are undoubtedly going to see opportunities coming out of this because there's going to be less competition in the SEE space. The Western European banks have got their problems at home to fix. The local players are in their own difficulties. So does this present the growth opportunity? That comes up to my point of why did Achilles have his heel in the first place? Assuming we can survive the Trojan War, I see no reason why the Greek banks can't home be the heroes of old. That's my conclusion. Thank you.